Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to the July 2019 edition of Fairport Flash. This is Katie Sheehan, Portfolio Manager at Fairport. I'm primarily responsible for assisting in developing and implementing the firm's investment strategy with a focus on equities and impact investing. Well, we made it through the first half of 2019, and despite some of the headlines and volatility, the S&P finished the second quarter up 18.5% year-to-date, while the 10-year Treasury yield ended right at 2%. Today, I'll highlight some of the tailwinds we're seeing as we enter the second half of 2019, items we're keeping an eye on, and what it all could mean for the equity market. On June 30th, we celebrated the 10th anniversary of the current economic expansion, and as you listen to this, it has now earned the title of the longest in U.S. history. First quarter GDP grew 3.1% during a pretty seasonally difficult period, largely due to inventory buildup in anticipation of trade concerns. Now, expectations are for a slower pace in the second quarter given the roll-off of those first quarter benefits to the print, and the Atlanta Fed GDP Now estimate is projecting growth of just 1.4% for the second quarter as of July 10th. That data release is set for July 26th, and consensus economist estimates are pointing to trend-level growth of around 2% for the rest of the year. So what's keeping this expansion going so long, even if it is at such a moderate pace? Well, the first is employment. Although employment reports have not been as strong as some have become accustomed to, the jobs number remains relatively strong. The unemployment rate was at just 3.7%, and we saw subdued wage growth of 3.4% for the June reading. The unemployment rate did take up modestly from the prior month, but that was due to an increase in the participation rate, which is a good reason. Generally, wage growth becomes more of a headwind for the economic cycle once it reaches over 4%, so we do have some breathing room there as well. Another bright spot is housing. We have seen reacceleration in recent months, particularly given lower long-term yields, and as long as those yields remain relatively low, that should continue to be supportive. A somewhat indirect recession indicator are credit spreads, or the difference between the yields on a riskier bond and a risk-free bond, such as Treasury securities. So a wider spread implies investors require additional compensation to take on more risk. So while spreads across the board are wider than their 2018 lows, they still remain within or below historical averages, so spreads aren't really indicating to us any glaring red flags at this point. So those are a few of the positives in the economy. What are some of the areas that are giving us a little bit of pause? Trade, it's certainly weighing on sentiment, which in turn is likely to have an economic impact. While market participants have been keeping a pretty concerned eye on manufacturing data, a not so bright spot in the economy lately, our friends over at Strategic Research Partners found that when the Global Policy Uncertainty Index is at the current levels, it's actually historically provided positive forward returns for the S&P in the varying periods measured. As that may be, trade development is something we will continue to monitor as the year progresses, as well as any potential impact it may have. While maybe a bit counterintuitive, those tariffs are actually deflationary. The logic is that consumers will typically push back purchases due to the inherent increase in pricing given those tariffs. So if there is less demand, prices generally just don't go up. So this deflationary impact, compounded with existing inflationary pressures, as well as low and negative bond yields worldwide, have really kept longer-dated Treasury yields at bay. We've mentioned the yield curve quite a bit on our recent podcasts, and that 3-month to 10-year spread has remained negative now for about 7 weeks. At the risk of repeating my colleagues as well as myself, ISI Evercore reports that historically an inverted yield curve is an indicator of recession if the spread remains negative by 15 basis points for 10 weeks. So we do have a few weeks to go, and there are certainly some distinctive circumstances this cycle, but it's one factor we're watching closely. The last big question mark is the Fed. The next Federal Reserve Open Market Committee meeting will be held July 31st, and it is widely anticipated the Fed funds rate will be cut by at least 25 basis points. The Fed set the stage for the potential easing following the June FOMC meeting, and given market expectations, which are currently at 100% probability for a 25 basis point cut, it'll be pretty challenging for the Fed to not make a move at that point. Chairman Powell also provided fuel to the proverbial fire on July 10th, indicating easing will likely be needed given potential trade developments as well as the upcoming debt ceiling and Brexit. We'll also be paying attention to the guidance provided in the statement and during the press conference after the meeting for any indication of expected policy into year end. But as of right now, the market is pricing in a greater than 50% probability of a September cut as well. So what does this all mean for the equity market? Well, the current base case is that we are not on the precipice of an economic downturn. Thus, an insurance cut is the likely rationale from the Fed at the end of July, given the admittedly low inflation we've been seeing. Historically, a rate cut has been good for forward returns for the S&P 500, especially if it's not followed by an economic recession. Additionally, the fact that the S&P has been hitting all-time highs is another potential positive for forward returns. The index hit an intraday high of over 3,000 on July 10th on those continued expectations of rate cuts. And given that rate cuts have historically been positive for the market and we continue to see momentum in the market, those are just a couple of reasons to maintain a relatively optimistic outlook on equities as we enter the second half of 2019. Lastly, the week of July 15th really kicks off second quarter corporate earnings, and while expectations have come in recently, growth is still expected for the remainder of the year so far. I know I've said it before, and it bears repeating that it's historically been the case that an economic recession has not occurred in the absence of a corporate earnings recession. But again, this is another area in which we'll be paying attention to guidance from both quarterly reports and conference calls for the remainder of the year, especially as it relates to the impact from trade. So that was a lot of different data points in a short amount of time. To sum it up, positives we're currently seeing in terms of the health of the economy are employment, housing, and those relatively tight credit spreads. Some items worth watching are obviously the trade war and the developments there, the inverted yield curve and potential Fed actions, as well as earnings guidance. Ultimately, though, we do expect there to be additional volatility into the second half of 2019 as some of these issues work themselves out or present additional uncertainty, but we do maintain a relatively positive outlook on equities, especially given valuations in other asset classes as yields have moved lower. This brings us to the close of today's Fairport Flash. As always, our goal at Fairport is inspiring families, and as a member of the investment team, we strive to do this through a long-term diversified approach. If you'd like to discuss any of today's general topics in more detail, please reach out to your Fairport team. Thank you for listening, and keep an eye out for the next Fairport Flash.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there's no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims and make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.